What if your money could grow in a way that cuts your taxes today and tomorrow? Today, we compare Roth IRA and 401k to find a practical path that fits real life, not a brochure. You've heard about retirement accounts, but choosing between a Roth IRA and a 401k can feel like picking the right gear on a bike with two different wheels. Let's keep it simple and practical. We'll focus on action. You can take this year to improve money management and long-term wealth. Roth IRA is funded with after-tax dollars. You don't owe taxes on money you withdraw in retirement if you follow the rules. A 401k is usually pre-tax. You get a tax break now, but withdrawals in retirement are taxed. The tax dance matters because it affects how much you actually keep years from now. There are limits and rules. You can only contribute so much each year, and income can change whether you're allowed to contribute directly to a Roth. Every plan has fees and investment choices that can make a big difference over time. The pattern you build now matters more than a one-time decision. The big lever is the employer match. If your employer matches, that match is free money. You should at least contribute enough to grab the full match before you spend money elsewhere. Missing that is leaving money on the table you won't get back. Roth advantages include no required minimum distributions during your lifetime and tax-free growth on earnings after you've held it for the right period. That means flexibility in retirement and no forced selling to pay taxes. The downside is you pay taxes up front on those contributions. 401k. Advantages include higher annual contribution caps and often a broader commitment from employers in the form of a match or automatic contributions. It also lets you set up a traditional tax-deferred plan that reduces your current taxable income. On the downside, you're in for taxes on withdrawals later, and some plans have high fees or limited investment choices. Your choice also depends on your income and the specific plan options available to you. If your plan offers a Roth 401k, in addition to a traditional 401k, you can mix and match in the same account. If you're eligible for a Roth IRA directly, that gives you more flexibility and control over investment options. Here's a practical, repeatable strategy you can use this year. Step 1. Always fund the employer match first. If your job offers a 401k match, contribute enough to get the full match before you invest elsewhere. That's the fastest, safest way to grow with someone else's money on your side. Step 2. Decide how to split the rest between a Roth option and the traditional side. If your plan offers a Roth 401k and you expect your tax rate to be higher in retirement, lean toward the Roth side. If you think you'll be in a lower tax bracket later, you might favor traditional contributions for now. Step 3. If you're eligible for a Roth IRA, consider contributing there after you've maxed the match. A Roth IRA gives you tax-free growth and more withdrawal flexibility in retirement. If your income is too high for a direct Roth, you can discuss a backdoor Roth with a tax professional, keeping in mind the complexity and potential tax implications of conversions. Step 4. If you can't contribute to a Roth IRA directly because of income limits, there are still paths to tax-free growth. A backdoor Roth is a common approach, but it requires careful handling to avoid unnecessary taxes. Another option is to put extra into a traditional 401k, now and then convert later if your situation changes. Step 5. Think about the long run. If you're early in your career and expect growth in your income, tax diversification can protect you. Having both Roth and traditional accounts means you're not gambling on a single tax outcome in retirement. A simple 3-bucket plan helps make this concrete. Bucket A is the 401k with the employer match. Bucket B is a Roth IRA if you're eligible, or a backdoor Roth if you're not. Bucket C is a taxable investment account for extra savings and flexibility. Each bucket serves a different purpose, and together they reduce risk from tax changes and market shifts. Let me bring this to life with 2 quick scenarios. Scenario 1. You're early in your career, earning steadily with a decent employer match and a moderate income. You contribute enough to the 401k to get the full match, then put money into a Roth IRA if you're eligible. If you're not eligible for a direct Roth, you consider a backdoor Roth carefully with a tax advisor. Any extra savings go into a taxable account to keep liquidity for emergencies or big buys. Scenario 2. You're in a higher income bracket and you expect your tax rate in retirement to be the same or higher. You maximize the match in your 401k, then lean toward Roth contributions in the 401k, if the plan offers a Roth option and you're comfortable with paying taxes now. If you're eligible for a direct Roth IRA, you use that too. If not, a backdoor Roth becomes more relevant, again with professional guidance to avoid surprises. If you don't know which path to choose, here's a practical rule of thumb. Favor tax diversification, have some money in a tax-paid now vehicle, Roth, and some in a tax-deferred vehicle, traditional. This approach makes your retirement safer against tax rate volatility and changes to laws. Fees and plan quality matter as much as the tax treatment. A cheap, well-diversified set of investments in a high-fee plan will underperform a slightly more expensive, broadly diversified option. Always compare the expense ratios, the fund lineup, and the advice available to you in any plan. The best choice isn't the one with the best tax headline, but the one you can stick with for decades. Here's a short checklist you can use in the next 15 minutes. First, confirm you're contributing enough to grab the full 401k match. Second, check if your plan offers a Roth option and decide whether you want to use it. Third, assess whether you're eligible for a Roth IRA directly. If not, ask about a backdoor Roth and get clear on the tax implications. Fourth, consider opening a taxable brokerage account for extra savings beyond retirement accounts. Fifth, set up automatic contributions so you don't leave money on the table by forgetting. This isn't about picking a winner forever. It's about building a flexible plan that can adapt as your life changes. Your career may take twists, and tax laws will surely shift again. A plan that includes both tax now and tax later gives you the leverage to adjust. If you want a practical next step, pick a target for today. Decide how much you'll contribute to your 401k to maximize the match by the end of the month. Then, check if you're eligible for a Roth IRA this year and set up automatic transfers if you are. If not, schedule a call with a tax advisor about a backdoor Roth and any risks for your situation. Finally, plan to review your plan every 6 to 12 months and adjust as your income, goals, and tax outlook change. A note on withdrawals and timing. Roth contributions can be withdrawn tax and penalty-free at any time, which gives you a small emergency cushion without tax cost. Earnings, though, have rules that require you to be older and to have had the account for a certain period. Traditional 401k withdrawals are taxed as normal income, and usually with a penalty if taken before age 59 and a half, unless you qualify for an exception. Roth 401ks have the same withdrawal tax rules as traditional 401ks when it comes to distributions. So many people roll a Roth 401k into a Roth IRA later to avoid mandatory withdrawals. You can also think about the long game in terms of real-life decisions. If you expect to move between jobs, a Roth IRA can be more portable for certain types of withdrawals and doesn't depend on a plan you may leave behind. If you're settled in a big company with a solid 401k and a strong match, it can be powerful to lean on that employer plan first while stacking Roth growth in parallel. Another practical tip: stay mindful of your overall financial picture. Debt, emergency funds, and ongoing living costs all influence how much you should allocate to retirement accounts. Avoid over-contributing to retirement accounts at the expense of building liquidity for unexpected life events. A balanced approach helps you stay out of trouble and keep momentum. In the end, the question isn't simply Roth IRA versus 401k. It's how you want to pay taxes, how much control you want over your investments, and how you handle employer benefits. A thoughtful mix reduces risk and creates a stronger foundation for long-term wealth. If you found this approach useful, hit the like button and share it with someone who's deciding between a Roth IRA and a 401k. I'd love to hear your situation in the comments. Tell me whether you're leaning toward Roth, traditional, or a mix. Subscribe for more practical money lessons that you can actually apply. See you in the next video.